How do I manage and set my trailing stops? This is a question I'm often asked by my subscribers, so I thought it was about time I tackled it today. It's obviously important to have a trailing stop strategy as part of your overall trade management strategy. As the trade starts to move in a profitable direction and you see the money accumulating in your account, you need to take steps in order to protect that money in case the market unexpectedly reverses. The key for me is not to trail the stop too aggressively. Some people have a strategy of moving the stop to break even as quickly as possible in order to get what they call a free trade. There's zero risk. In the worst case scenario, they break even and they see that as a free trading opportunity or a low risk trading opportunity. Okay, I get it. It obviously mathematically makes sense. For me personally, I don't like doing that because my strategy involves trading support and resistance levels. Now, if I've gone and bought at a good support level in a bull trend, I consider that to be a gift. That's my edge. That's how I identify low risk trade opportunities. I don't want to trail that stop to the entry point quickly because I don't understand why I would want to get stopped out at the level at which I thought it was a great buying opportunity. Other people might have different entry strategies. They may be a bit more random. And so if they can quickly trail the stop to break even, I totally understand why that works for you. So you have to decide whether you want to do that or whether you want to be less aggressive about trailing the stop like me. So how would I do it? Well, I usually set 2 or 3 targets for my trade. When I get to the first target or close to it, I'm then thinking about, right, trail the stop, cut down the potential loss. That's my first thought. Cut down the potential loss, not move the stop to break even. So I might move my stop halfway or even 3/4 of the way to my entry point from the original stop loss price. Then I know I've cut down the potential loss significantly, but if we get a retest of the entry point, I'm not going to get stopped out. If we break the entry point and we start heading lower, then I will be out quickly and the loss will be very minimal. That to me works. When I get to the first target, I might also be taking a partial profit on the position. And of course, when we hit the first target, the profit on the trade should be bigger than the potential loss would have been if I'd hit my original stop loss, okay? Because of course, we're always looking to make more than we risk. Now, the second stage for when I trail my stop would be when I head towards the second target. I may take all the profit at the second target, by the way. Sometimes I have 3 targets, but sometimes only 2 targets, or sometimes I will decide to take all of the profit at the second target and not even bother to try for the third target. It depends on how I feel about the market, what kind of candle formations I'm seeing. Anyway, when we head towards the second target or hit the second target and you're only going to trail the stop and maybe take a partial profit, I would then be moving my stop, say somewhere between the entry point and the first target. Then, in the worst case scenario, I'm guaranteed to make profit on the trade. And if I take a partial profit again at the second target, I'm already locking in some money. Let's say I take 1/3 of the profit at target 1, 1/3 of the profit at target 2. I'm now out of 2/3 of the position. And for the remaining 1/3 of the position, I'm then going to trail my stop halfway or so between the entry point and the first target. So the worst case scenario is I still pick up a bit of profit on that remaining portion of the trade. Now I'm going to give you some other ideas of how you can manage your trailing stop that might suit your strategy better. Firstly, you could have a percentage trailing stop. I don't actually use this, but it could be a good strategy if, for example, you're buying into the stock market on a swing trade and you want to hold a position, you're buying gold and you want to hold a position for days or even weeks. If you have a percentage stop, so let's say you're buying into, I'm going to call it 1,000. Let's say you're buying into an index, a stock market index, and it's at 1,000. You could have a 2% stop. So you decide if the market's dropped 2%, that's too much for me. I want to be out of the position. That's as much risk as I'm prepared to take. So if the market were to drop to 980, I want to be out and I'm going to then reevaluate my risk. Then as the market moves up, you trail your stop. So the stop is always 2% of the current market price. Now, let's just, to make numbers easy, let's say the market goes to 1,500. Okay, 50% is a big jump, obviously. It's not realistic. But let's say that happens. Your trailing stop would then be 2% of 1,500. So your trailing stop would be 30 points. And you would then move your trailing stop up to 1,470. In point terms, obviously, your stop widens as the market moves in your direction, which I kind of like because it gives you extra breathing space. But still, another popular stop loss trailing strategy is to use the ATR, the average true range. So whatever time period you're trading, let's say it's the daily time frame that you're looking at, the daily chart, because again, you're a swing trader, look at the average true range. If the average true range is, let's say, 50 pips, you might decide to set your stop loss at 60 or 65 pips, just a little bit outside of the average true range. So if the market does decline, if you're long, if the market does decline by a greater amount than the average true range, you might decide, okay, that's it. I don't want to be in this trade anymore. Clearly something is changing that I don't understand. The third alternative strategy is just to use the price action. So if you're long, where was the previous swing low on whatever time frame is relevant to what you're trading? For me, that would probably be the 4-hour chart. If I'm long, I'll look at the previous swing low. Okay, if we break the previous swing low, I'm going to question whether we're still in that short-term bull trend. So I'll want to get out of the position to protect myself. If it's a Forex trade, I might have my stop 10 pips below the previous swing low, something like that. And the fourth alternative would be to use technical indicators to move your stop. So for me, I love Fibonacci levels. If we're breaking above a Fibonacci level and I'm making money on the trade, I might decide to trail my stop to just under that Fibonacci level. I'll assume that that Fibonacci level will be now a support level. If it breaks, I want to be out of the trade. So I might have my stop loss trail up to 10, 15, maybe 20 pips below that Fibonacci level, and then I'll feel protected, and I'll know that if we break below that Fibonacci level, I will want to be out of the trade, because the trade won't be working as I expected, because it won't be able to hold above those important Fibonacci levels once it's been broken above. So it might indicate it's a false break, and therefore I want to protect myself on a false break above a resistance level. Or it might be a moving average, it might be a trend line, any of those tools that I often use as guides to where to place my stop loss. I hope you found that useful. If you've got an alternative idea or an alternative strategy on how you plan your trailing stop losses, let me know in the comments. And please, if this has been helpful, like, share and subscribe.